company may occasionally buy back its own shares from shareholders. There are no tax consequences for the company, but for the individual shareholder, it will depend upon whether the buyback was an off-market or on-market buyback. Lisa Mills owns 5,000 shares in Telco Limited. Her cost base is $10 per share and the current market value is $15 per share. Telco decided to buy back Lisa's shares for $17 per share. The buyback consideration payment was debited $8 against the share capital account and $9 against accumulated profits. So what are the income tax and CGT implications of the share buyback for Lisa Mills? Firstly, we need to establish whether the transaction is an off-market or on-market share buyback. As the shares are not listed on the stock exchange, it is not an on-market share buyback. So consequently, this is an off-market share buyback. In which case, the difference between the purchase price and that part of the purchase price debited against the share capital account of the company is treated as a dividend paid to the shareholder out of the company profits on the day of the buyback. The dividend is also a frankable dividend subject to imputation credits. So the income tax implications for Lisa will be that she is treated as having received an assessable dividend of $9 per share, which is the $17 purchase price less the $8 debited to the share capital account. With her holding of 5,000 shares at $9 dividend per share, Lisa will have to include $45,000 in her assessable income. Given the consideration paid is $17 per share, to prevent any double taxation in calculating the potential capital gain, the consideration received by Lisa on disposal of the shares will be reduced by a reduction amount, which is either A, equal to the amount of the assessable dividend, or B, an eligible non-capital amount. That is, an amount that is not debited or attributed to a share capital account or an asset revaluation reserve. In most cases, it will be the assessable dividend. So, the CGT implications for Lisa are that the consideration of $17 per share will be reduced by the reduction amount, which in this case is the assessable dividend of $9. This leaves an adjusted value of $8 per share. As Lisa's cost base per share was $10, she's actually made a capital loss of $2 per share, and her total capital loss is $10,000. We should note that if the buyback price is greater than the market value, as was the case here, any part of the buyback price attributable to the excess over the market value is not a frankable distribution. Alternatively, if the buyback price is less than the market value, then the shareholder will be deemed to have received an amount equal to the market value. For on-market share buybacks, no part of the buyback price is treated as a dividend, and the total amount received by the shareholder is treated as consideration in respect of the sale of the shares for both income tax and CGT purposes. In Lisa's case, this would have been $85,000. We should also note that a franking debit arises in the company's franking account on the day of the buyback. To recap, we need to remember that there are both CGT and income tax implications for individual shareholders with respect to share buybacks, but not any for the company itself.